We have a couple questions from Twitter. Emily Liner from Third Way asks if Mr. Tarullo can speak to the reasoning for risk weighting in light of Rep. Henserling, who's chairman of the House Financial Services Committee, with his leverage ratio proposal.
Sure. So there have been proposals around to substitute for other capital requirements a single leverage ratio requirement. And again, just to make sure everybody's on a common foundation here, you have capital requirements for banks can be based either on just the dollar size of the balance sheet. So you take the amount of capital and divide it by the size of the balance sheet. That's called a leverage ratio. Second way to do it is a risk-weighted approach, which takes the same number in the numerator, but adjusts the denominator based on the relative riskiness of the assets in the bank's portfolio. The idea of the risk weighting is that obviously a portfolio can pose very different dangers if it's composed of a lot of unsecured lending to people with no income stream, as opposed to very safe lending that is done by another institution. The size of the balance sheet in dollar terms may look the same, but the riskiness is different, so you say we have different capital requirements. An idea has been to say, well, if you just have a higher leverage ratio, 10% I think is the current proposal, that should cover anything that's risky, and therefore you can just have a single capital requirement.